Hey, what's up? Welcome back to Chalk Talks with Coach B. 1 week ago, SpaceX went public, ticker SPCX, and last week I told you exactly what not to do. Don't chase the open. So let's grade that. It opened around 150, ripped to 225 intraday by Tuesday, and now it has given the entire pop back, trading around 155 as I post this. From 150 open to 225, all the way back to the launch pad in 1 week. If you bought the open and just held, you're basically flat. If you chase that 225 high, you're down more than 30%. Same stock, same week, completely different outcome, and the only thing that changed was your entry. That's the whole lesson from part one, playing out in real time. But today I want to show you two things you literally could not see on IPO day. The first is a clock that's quietly ticking on every freshly public stock. The second is brand new. SPCX now has a real options chain. So let's actually read it. So here's the thing about a company that just IPO'd. The shares trading right now are only a slice of the total. Insiders, employees, and early investors are holding the rest, and they're contractually locked up, usually for 90 to 180 days from selling. When that lockup expires, a big new chunk of supply can hit the market all at once. More sellers, same buyers, and the stock often gets pressured into that date. This is not a SpaceX prediction. It's basic supply and demand that plays out on almost every IPO. So the smart move isn't to guess the direction, it's to know where the lockup date is on the calendar before you size a position, because that's a known supply event hiding in plain sight. Now, the part that's actually new, SPCX has options now, and this is its first real chain. Pull it up, and the very first thing that jumps out is implied volatility. The at the money call is showing around 90% IV. For context, a sleepy blue chip might sit at 15 or 20. 90% is the market screaming, I have no idea where this settles. And here's the tell. Even after the stock fell more than 30%, that IV did not cool off. The fear is still fully priced in, and that IV is not free. You pay for it in the premium. Look at the at the money call. Now, the 155 strike about a month out. It's trading around $16.40. That's $1,600 for one contract. On a $155 stock, you're paying roughly 10% of the share price just to control it for 1 month. The stock has to move more than 10% in your direction just for you to break even at expiration. That's what high IV does. It raises the bar. And here's the trick the chain gives you for free. Take that at the money premium, roughly $16, and that's the market's estimate of the expected move by expiration, plus or minus. So the chain is literally telling you the market expects SPCX to swing about $16 either way in the next month. Now, the lockup clock and the chain connect. If you know a supply event is coming and the options are pricing a huge move, you understand why the premium is this expensive. It's not random, it's risk priced. So put it together. A newly public stock has a known supply event on the calendar. The options are pricing a violent move, and Theta is bleeding the at the money call about 25 cents a day. If you buy that expensive premium and the stock just chops sideways or IV cools off as the hype fades, you can be right on direction and still lose because you overpaid for the move. Same Greeks lesson from the options videos, just on the hottest ticker on the board. This is the part two nobody does. Everybody covers the IPO pop. Almost nobody comes back a week later to show you the lockup clock and the real chain. That's the difference between hype and homework. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell SpaceX. I'm showing you the mechanics so you can think for yourself. That's your week one breakdown. If this helped you see past the headline, smash that like and subscribe and drop a comment. What ticker do you want me to pull the real chain on next? Good luck in the markets, no matter what stock you're into.